Namaskar, hello and welcome friends to Invest I-33. My name is Shushmitaditya Mukherjee. I'm an educator and investment research analyst. And in this video, we have attempted to value one of the most renowned stocks owned by Berkshire Hathaway, which is Bank of America. Now, as Mr. Mohnish Pabrai, a stalwart investor at the global stage, says, be a shameless cloner, here we have tried to do exactly that. We have taken inspiration of the valuation method from the dean of valuation, none other than Mr. Aswath Damodaran, and the stock obviously is part of Berkshire Hathaway, as we have already said. So let's get started. Hope you enjoy the video.
So friends, as promised, right now we are going to find out the intrinsic value of Bank of America primarily through the classical ways of valuation. Now there are three classical ways of valuation that is conducted in the financial world. They are dividend discount model, discounted cash flow model, and residual income model. These are the three primary ways through which we can find out the intrinsic valuation. These are highly tested and highly accepted ways of valuation. Now, what is the meaning of intrinsic values? As Warren Buffett and any number of stalwart investors will say, that is the present value of future income. Present values of future income or future cash flows. This is what is the meaning of intrinsic value of a business or a stock, right? Now to find this out, these three modes are applied. First is you use the dividends to find out the valuation. Then you use the cash flows, the free cash flows to find out the valuation. Then you use something called the residual income, which is income in excess of the cost of equity to find out the present value. And one by one, we'll use all these methods to find out the valuation of Bank of America, then choose the weightages we are going to give to each one of them, right? So we'll start with a simpler version, which is the dividend discount model. Now, according to dividend discount model, the intrinsic value or the present value of a business is given by the dividend at the current period, D0, multiplied by the growth rate. This expression divided by the cost of equity of the business minus the growth rate. Now, this is a mathematical term. We need to simplify and understand what this is meant. Now, in terms of dividends, the value of a stock, you can write it like this. The present value of a stock can be written as dividend in period 1, that is the first period after investment, plus dividend in period 2, plus dividend in period 3, till dividend up till perpetuity, right? Dividend up till perpetuity. Now, if this expression is defined by a certain constant growth rate, which is very valid for a matured company like Bank of America, if it's a matured bank or any other company in a matured industry, the growth rate tends to be stable and constant. That is, a single stage of growth remains to be there. In that case, what happens is this entire expression can be derived to this part. Present value dividend multiplied by 1 plus the growth rate in percentage terms or in decimal terms divided by the cost of equity minus the growth rate. Now, the current dividend we already know. The growth rate we can derive from the financial numbers, and the cost of equity also we can derive from the financial numbers. Now, one by one we'll go about finding out what each of these values are for Bank of America. First, let us write down what is the current dividend. Now friends, this is a website called finviz.com. And here we can see the dividends per share per year for Bank of America Corp. And here you can see in the year 2014, the dividend is $0.20. You can see here, let me highlight it. In 2015, the dividend per share is $0.20, right? And in the year 2024, the same dividends has increased to $1 per share. $1 per share, right? So the current dividends is $1. So we write D0 is $1, right? Here we write $1. Now, our next job is to find out the growth rate in perpetuity. The growth rate in perpetuity that Bank of America will encounter in terms of its dividend growth rate. Now, for perpetuity, we can take the reference of the risk-free rate to set the perpetual growth rate. Now, why we are using the risk-free rate? Because we find that USA is one of the most financially stable companies, specifically for its reserve currency status at the current stage, and also its industries are much larger compared to many other nations, and they are much more stable in their growth rates. So we can use their risk-free rates, in more precise sense, the 10-year treasury rates, and look at their trends to decide on what growth rate we want to use here. Now let me take you to a chart where the 10-year treasury rates for the last 50 years is shown. Let me see what happens there. Now here we are watching the trend of the 10-year treasury rates for the last 50 years, 54 years to be precise, and you can see in the year 1981, the rates reached almost 16%, around 15.5%, right? This is the Paul Volcker period, and around 10 years after the fiat currency status was achieved by US dollar. Now from then on, there has been a steady decline. You can see the rates have declined. The peaks have been coming down. The bottoms have been also coming down. They have been coming down steadily until 2012, when the rates reached sub 2% levels. Here the rates you can see is 1.57, 1.58%, and they reached further lows during the 2020 period, when the rates went down till 0.60%, right? And after that, the rates have been raised. Because of the higher inflation numbers, the Fed has been forced to raise the rates for obvious reasons, and they have been taken up till 4.30. Here the rates are 4.47. Let's say around 4.5% the rates have been taken up towards. So we can do one thing. We can take the mean of 2012, 2020-21 and 2024-25 and decide our perpetual risk-free rate, because we are covering certain variations in the market cycles and then adding them up to get our rates in perpetuity. Here, mind you, one very important assumption we are using is, in the foreseeable future, we see the dollar to be very, very stable, and in fact compared to other currencies to be very, very strong also, right? We do not expect hyperinflation or very high inflationary scenarios with the US dollar, even in the domestic scenario or in the exchange rate scenario. In either case, we are not seeing this. So in the foreseeable future, we see internal and global stability of the US dollar, and based on that, we are taking a mean of 2012, 2020-21 and 2024-25 as the number to be taken for the risk-free rate, right? Let's calculate it. So here the number is, let's take the rate of 1.5% plus, it was 0.6%, right? 1.5%, 0.6% plus 4.5%. Let me take the mean of these three numbers. This is an approximate number, right? We are not taking the precise values here. We are taking just approximate numbers to get to be approximately correct in our judgment. You cannot be 3 decimal places correct in your judgment. Here we are just trying to be approximately correct in our judgment, and this will be good enough for us. So here the number is 1.5 plus 0.6 plus 4.5 divided by 3. So the perpetual rate is 2.2%. 2.2% is the rate we are taking here. Now the next job is to find out the cost of the equity. Right? Once these three values are there, we are also in a position to calculate the intrinsic value in the first way, that is the dividend discount model way of doing things. Now, how do we calculate the cost of equity? Now, due to multiple changes in the policies of capital adequacy, in the health of the financial assets that the banks hold, it is better to use something which does not use the beta in calculating the cost of equity. It is much better to use some other way around it. Now, there obviously is a way around it. Let me tell you which way that is. The mathematical equation we are using here is actually known as the Gordon Growth Model, GGM, right? This is a particular way of finding out the valuation of stock, defined as the Gordon Growth Model. Now, based on the same Gordon Growth Model, one more derivative of this equation is there. The Gordon Growth Model depicts or says that the price to book value of a company or a business is given by the difference between the return on equity minus the growth rate divided by cost of equity minus the growth rate. Now this can be for a business, for an industry, or for a sector. right? Now here we are looking at this equation in terms of the banking sector, and based on that we are going to derive the cost of equity. We are going to zoom into the specific sector or specific segment of the industry in which Bank of America or large banks like Bank of America belongs to, and take out the cost of equity from this equation by putting in the values of the price to book ratio, the return on equity, and the growth number, right? That's what we are going to do. So the three things that we need one by one are price to book value, average return on equity of the banking sector or the large banking sector, then the growth rate we already have, and if we have these three values, obviously we can calculate the cost of equity. Let's find them one by one. Number one, the price to book value of this large banking sector. Let me show you what that number is in a website. Now this is the website of NYU Stern, and here sector wise the price to book values and the return on equities are mentioned for every sector. Now our bank belongs to the money center bank segment. The money center bank segment. This is the segment that we are looking at. I am highlighting it, selecting it here so that it gets highlighted, and the numbers mentioned are here. Now there are 15 firms, only 15 firms in this money center segment, and the price to book value there is 1.32. It is the average price to book value. The return on equity is 11.52%. Again, this is the average return on equity. So we already have the two values and we already know the growth rate. So let us use these values to find out the cost of equity. So the price to book value average for this sector in which Bank of America belongs is 1.32. The return on equity average for the sector is 11.52, I guess. Let me see it once again. 11.52%, yes. 11.52%. And the growth rate we are already aware of. We have calculated it, or we have assumed it to be approximately equal to 2.2%. So we have the numbers here. We just need to put it and get our cost of equity. So if you derive this equation, then it becomes 1.32 is equal to, return on equity is 0.1152 minus 0.022 divided by cost of equity minus 0.022. Let's just derive it. Take out the calculator and you can easily derive it. This is 0.1152 minus 0.022. The cost of equity from this calculation is coming to be 0.0926 or 9.26%. 0.0926 or 9.26%. So we have our numbers that we can apply now. So cost of equity becomes 9.26%, right? Now friends, we are in a position to derive the intrinsic valuation for Bank of America. Now this is equal to, now let's do one thing. Let's go to the Excel and calculate the values. So friends, here we are in the Excel sheet, and our first job is to find out the valuation for Bank of America through the dividend discount model, right? So the dividend discount model is highlighted here, you can see, and we have already the values of current dividend, the growth rate, the cost of equity, from which we can find out the intrinsic value per share with respect to dividend discount model of Bank of America. So let's get on with the calculations. The current dividend is $1. The growth rate is 2.2%, so 0.022. The cost of equity is 9.26%. Let me confirm it once again. The cost of equity, yes, it is 9.26%. So let me write that down. 0.0926. Okay. Now based on these numbers, the intrinsic value per share is equal to current dividend, which is 1, multiplied by 1 plus the growth rate, divided by cost of equity minus the growth rate. Cost of equity minus the growth rate. Right? It is coming to be $14.475 per share. Now friends, here one thing that we have not mentioned yet is that we have considered that the payout ratio is going to be constant. The payout ratio means the percentage of the earnings that the company is paying out as dividend. Here we have considered, this is our assumption, that the payout ratio is constant. But if you look at the chart once again, you will see that the payout ratio is not constant. It is increasing year on year. Let me show you once again. Now you can see the chart here. Here the purple line is the payout ratio. You can see this has a growth trend. This is growing year on year. Growing year on year. For the last 10 years it is growing. Not consistently, but it has a trend of upward movement. And what is the growth trend for this? This was 15.31% 10 years back in 2015, and now it is 31.12%. So in the last 9 years, it has doubled. The payout ratio has doubled. Now, up till what limit it can increase? Let me assume that in the next 10 years, the payout ratio will become from 31% to 50%, and at 50%, it will become constant. So now the calculation becomes a little bit different. Okay, so let me calculate it once again. So let me write down the year numbers here. The current dividend is in year 0, right? Then there is year 1. Then there is year 2, year 3. Like this till year 10, it will become 50% and then it will become constant, right? Now, let me add the payout ratios also. So let me push these numbers down one row and let me enter the payout ratio number here. So right now it is 31%, so 0.31%. I am assuming that in year 10 it will reach 50% and then become constant. So let me write here 0.5%, and in between these numbers are distributed. So 0.33, 0.35, 0.37, 0.39, 0.41, 0.43, 0.45, 0.47, 0.49 and 50. So I have made this assumption that 50% dividend payout ratio, it will go up to, then it will become constant. And now something interesting happens, friends. The growth rate is enhanced. The growth rate is enhanced in the next 10 years. The growth rate is actually multiplied with the payout ratio to give you the entire growth rate. So the growth rate in the year 1 is equal to 0.022 multiplied by 1 plus the payout ratio growth rate. Now friends, here you can see we have incorporated the increase in payout ratio with respect to the growth rate. And from year 11 onwards, the growth rates we assume revert back to 0.022, that is 2.2%. That is, after the payout ratio reaches 50%, the payout ratio stabilizes, and therefore the growth rate of dividend reverts back to the perpetual growth rate, right? So now we can revise the dividend payouts for these first 10 years. Now this becomes 1 into, this is the, so the year 1 dividend becomes year 0 dividend 1 multiplied by 1 plus the new revised growth rate, which incorporates the payout ratio increment, right, is equal to 1.0234. Now we just extend this till year 10 and we get our first 10 years of dividend payouts. Now what has happened is the growth has been divided into two phases. The first phase is this next 10 years when the dividend payout ratio is increasing, and then from year 11 onwards the payout ratio stabilizes. So first what we'll do is we'll find out the value of the company 10 years down the line, right? The value of the company 10 years down the line, let me mark it in yellow here. You can see here, let me write it intrinsic value 10. Year 10, what is the intrinsic value? This will be calculated as dividend in year 10 multiplied by the perpetual growth rate, which is 2.2%, because now the payout ratios have stabilized. So 1.022 divided by this, divided by the cost of equity. Cost of equity, we keep it constant, which is 9.26% minus the perpetual growth rate, which is 0.022 or 2.2%. Now we have this value of $17.7149219, right? This is the year 10 valuation, right? Now we also need to calculate the dividends that we are earning till year 10. Now we have earned in year 1 1.0234 something, year 2 1.0488 something, year 3 1.07638. Like this we have earned these dividends. These things we have not taken into account. We have just taken the valuation from year 11 onwards, from year 11 till perpetuity. But we also need to incorporate these dividends, year 1 to year 10. These dividends we have to incorporate. Now how do we incorporate it? We incorporate it by calculating the present value of these numbers. So let me insert another cell here. Present value or PV of the dividends in the first phase. Now if you are an equity investor, the cost of equity is your reference frame to calculate the present value, right? So here what we'll do is we will discount the dividends with respect to the cost of equity for each year. So let me do one thing. Let me copy the cost of equity for each year here. Right? Now here we have this present value row. Let me mark it with some color. Yellow color only, right? Now in year 10, the calculation will be year 10 dividend divided by 1 plus the cost of equity raised to the power the number of years. Raised to the power the number of years, which is 10. For year 9, it will be dividend in year 9 divided by 1 plus the cost of equity in year 9 raised to the power the number of years. So this is raised to the power 9, right? Now in this way we can deduce all the numbers up till year 1. So what I have done is I have just added these numbers. You can see here I have added this row of numbers so that I do not have to write all the year numbers here. I can just stretch it at one go, right? So what I'll do is year 8 present value is dividend in year 8 divided by 1 plus the cost of equity raised to the power the number of years. Now the number of years I have already written here separately. So I'll just put it here, and then what I'll do is I'll stretch the value till year 1. Now you can see we have deduced all the present values of dividend incomes in the next 10 years. But one thing is still left. We have the value of Bank of America 10 years down the line, but this is not reduced to the present value. So what we need to do here is this 73.71, this entire thing we need to discount to the present value. This will be again equal to entire expression divided by 1 plus the cost of equity to the power 10. 1 plus the cost of equity raised to the power the number of years, which is 10. Now we get the actual present value. Okay. Now here we have all the numbers that are required to calculate the current present value of Bank of America in dividend discount model in my mind, right? So here the intrinsic value with respect to dividend discount model for Bank of America is equal to sum of all these numbers. That is sum of all the years of dividends, 10 years of dividends, plus the value of Bank of America 10 years down the line. This comes to be 48.349. This comes to be 48.349. Now currently if you check the valuation of Bank of America, you will see, let me show you, it is 43.2. So if you ask me, according to my calculation, still even in these market scenarios, Bank of America is still undervalued, right? Considering that the payout ratio is going to keep on increasing till the 10th year from now, and which is a very important factor here, because we are seeing there is a trend increase in the payout ratios, and this is a very important inclusion when you're trying to calculate Bank of America, because we are looking at industries which are maturing, which are expanding at levels which are unforeseen. So therefore we have to assume things what are going to happen in the future and make a good guess out of it. Here the good guess is till 50% the dividend payout ratio should increase, and after that it could stabilize, right? Because in my calculation the equity requirements could be satisfied, and at the same time the investors who are looking to earn dividend income, they are also sufficiently satisfied with the returns. So here is the calculation for for Bank of America through dividend discount model. Now more exciting parts are still pending, which is free cash flow and residual income. We'll do that right away. So friends, here we have done the dividend discount model valuation for Bank of America. But there has been a lot of guessing done here, right? So we started with the dividends of $1. Then we saw that the payout ratio itself is changing, and because it is changing, we had to incorporate it and then redo the valuation. And we assumed that the payout ratio is going to stabilize at 50%. That is a guesstimate, right? Because investors in equity do not want an extreme amount of payout ratio, because that symbolizes that the market has itself saturated, that growth prospects are not there. Assuming this aspect, we said that the payout ratio will stabilize at 50% from year 10 till perpetuity. And based on that, all these numbers came out. And the value came out to be per share $48, $48.35 approximately. But what if you wanted to reduce the amount of guessing that has been done here? Here there has been a lot of guessing done. I just want to reduce the number of guessing and want to use a more classical and more robust and more widely accepted way of valuation, which is discounted cash flow valuation. But here friends, in case of a bank, the cash flow definition itself is a little bit different. Because in case of banks, the debt is more like a raw material. For example, let's say Bank of America is taking loans from the central bank at, let's say, 4%. And it is giving loans at 6% or 7% or 8% or whatever. And the margin that is there is basically running the business, running the expenses, running the earnings, etc., etc. So basically, they are taking debt as raw material at lower price and manufacturing different other debt instruments and creating assets out of them and selling them to borrowers at higher interest rates. That higher interest rate is basically the source of the margin. So let me write it down that for banks, debt is a raw material. Debt acts as raw material for financial services companies, and that's what makes the calculation of free cash flows and therefore the calculation of discounted cash flow much more different and much more interesting, right? So let's do it once. Discounted cash flow valuation for banks, specifically Bank of America. But first we'll understand how the discounted cash flow or the cash flow calculations are done for a bank. That is very important, friends, because it is not the same as the free cash flow for a other business like a manufacturing business or a service-based business or a product business, right? It is different. So how do we calculate it? Let's understand right away. So let's do the calculation, friends. Let's take an example here first. Let's say in the year 2023, there is a bank XYZ which had a loan book of $500 million. $500 million was the loan book, and it intends to increase the loan book by, let's say, 8% in the year 2024. So in the year 2024, it intends to have a loan book of 8% plus 500 million, that is 500 into 1.08, this becomes 540 million. Okay, 540 million is the loan book it expects to create in year 2024. Now in the year 2023, they had a net earnings of, let me write here the loan book first. First item is the loan book. Then the net earnings or the net income in year 1, let's say, was 120 million. Now before creating the loan book of 540 million, there is one more thing that a bank has to take into account. That is the capital adequacy ratio. The capital adequacy ratio. Let's say for Bank XYZ, the capital adequacy ratio is 10%. It is 10%, let's say. And the capital adequacy of tier 1 here, particularly tier 1, this is measured on another metric which is called the risk-weighted assets. Risk-weighted assets. This is a bank-specific or financial services-specific asset item that is found in the financial statements of a bank. You can check any annual report of any bank. You will find risk-adjusted assets or risk-weighted assets in that, and the capital ratio of tier 1 or capital ratios as a whole is measured on the basis of this, right? Let's say the risk-weighted assets. Now this risk-weighted asset is also a Now this risk-weighted asset is also a regulatory term. It is bound by regulations. So let's say right now the risk-weighted asset is 20 billion. It is 20 billion and the regulations require the bank to increase it by 5%. So right now it is 20 billion. An increase of 5% means 20 into 1.05. The increase has to be 21 billion, right? 21 billion. Okay, let me change the color here. 21 billion. Now the capital adequacy requirement is 10%. So this is measured on the risk-weighted assets. So in year 2023, the capital adequacy requirement for tier 1 capital was 10% of 20 billion, which is 2 billion. 10% of 20 billion is 2 billion, right? And if the capital adequacy requirement remains the same, the requirement in 2024 will be 10% of 21 billion, which means it will be 2.1 billion, right? Because this capital adequacy of tier 1 is 10% measured on the basis of the risk-weighted assets, RWA, right? Now you can see one thing. The capital required to maintain the regulatory numbers has increased by 0.1 billion. That is, the increment has been the increment of capital required to maintain the capital adequacy ratio is equal to 0.1 billion, right? Or 100 million. Now this amount, where do you get this amount from? Obviously, you have to take this out from the net income and reinvest it into the bank's equity, right? So here in the year 2023, this 120 million is our net income and the reinvestment that is required is 100 million. So we calculate the free cash flow of this bank in the year 2023 as net income minus reinvestment required. This is equal to 120 million minus 100 million or $20 million. This becomes our free cash flow calculation, and this same calculation we will do with respect to Bank of America and see how it goes. So firstly, we will need to understand what is the net income amount, what is the risk-weighted assets, and what is the capital adequacy requirement or the capital adequacy that the bank is maintaining. Now friends, this risk-weighted asset is basically a regulatory term which is an adjusted version of the loan book itself. So these numbers, the risk-weighted asset basically indicates the way in which the loan book is growing on a broader sense, in a regulatory adjusted way. Now we can try to understand what these numbers are for Bank of America by going into their annual reports. So let's hop into their annual reports for 2024 and a backwarded annual report, let's say of 2020. So let's do that. Now in the year 2024, you can see I am here in the annual report for Bank of America, and you can see here tier 1 capital is mentioned, total capital is mentioned, and risk-weighted assets, the number that we were talking about, is also mentioned here. Tier 1 capital ratio is also mentioned here. Now the numbers here are two-pronged. One is a standardized approach and other is the advanced approach. We will take the lower of the numbers. Okay, we'll take the lower of the numbers. Here, according to the advanced approach, the number of risk-weighted asset in billions is 1490 billion in the year 2024, and the tier 1 capital ratio at that time, is 15%. It is 15%. So we will use these numbers and try to calculate the trajectory of growth of risk-weighted assets, that is the loan book in a broader sense, and also the capital ratio. But first, let's also look into the number for 2020, what that is. So this is the 2020 annual report, friends. Here you can see the number mentioned here is, let me show you, zoom in a little bit. Here again you can see the tier 1 capital, the total capital, the risk-weighted asset in $1 billion is mentioned, and the tier 1 capital ratio is also mentioned. Now here you can see in the year 2020, the risk-weighted asset is 1371 billion. The risk-weighted asset is 1371 billion and the capital tier 1 capital ratio is 14.6%. So we will use these pair of numbers for 2024 and 2020 to calculate our growth trajectory for the loan book and also the capital requirement. Okay. Let's do that. So friends, here we have calculated it. You can see in the highlighted portion here, we have taken the risk-weighted asset in millions for 2020 and 2024, used the numbers of capital adequacy ratio for tier 1 capital 14.6% and 15%, and based on these two numbers we have calculated the respective tier 1 capital also, right? We have calculated the tier 1 capital here. Let me highlight it in yellow. Now based on these two numbers we have a distance of 4 years, and now based on these two numbers we can actually calculate the risk-weighted assets growth rate and the capital growth rate both. I have written here loan book growth rate, but it should be risk-weighted assets growth rate. This is the regulatory term for the assets in a bank, the total asset base of a bank, right? So here you can see the growth rate is 2.1% and the capital growth is 2.8%. So on an average we can say that this is following the trend growth rate of 2.2%. So we can take the growth rate for reinvestment requirement, for loan book growth requirement as 2.2% and then do our calculations. So how we will do our calculations, let me also tell you that. Let me go back to the blackboard once. How we'll do the calculations is, we will take into account the current year's risk-weighted assets and project what is going to be the risk-weighted assets in perpetuity. Right? In perpetuity, what is going to be the risk-weighted assets? That's what we are going to calculate. And we are also going to calculate based on that what is going to be the capital requirements. What is going to be the capital requirements? This also will project. And once we have the capital requirement, we know based on their increment, we can calculate the reinvestment requirement also. Right? Reinvestment requirement also. And we can already find out the net income from the financial statements, and we'll calculate the free cash flow by subtracting reinvestment requirement from net income. We'll calculate these numbers, the FCFF numbers, and then what we can do is we can find out the present value of these cash flows and get our intrinsic value for Bank of America. So that's what we are going to do in the Excel sheet. So let's start. The current risk-weighted assets is 149,000 million. So let me use this number here, right? Now let me assume this is the base year risk-weighted assets. Now let me assume that the growth rate is going to be 2.2% only. So here I multiply this with 0.022. So 149,000 into 0.022. I multiply this number with 1.022. That is, I consider a growth rate of 2.2%. So 1.022. This becomes 1522780. And I just project it till the 10th year. I project it till the 10th year and I get the numbers of risk-weighted assets for the next 10 years like this. Okay. Now, capital adequacy ratio the bank is maintaining. Let me take an average of 14.6% and 15%. So let me take 14.8% as the ratio the bank is maintaining. Okay. So 0.148 or 14.8%. So this number the bank is maintaining altogether, right? This is the number. And based on this number, I can calculate the respective tier 1 capital also, right? So this is equal to 0.148 multiplied by the risk-weighted assets. This is the tier 1 capital for base year, and let me extend it for all the years till year 10. And I have all these numbers. Now you can see here, we have already calculated the reinvestment requirement here. Now the reinvestment requirement is basically the increment in capital, tier 1 capital that is happening. So this is, let's say for the year 1, the increment is year 1 minus base year. For year 2, it is year 2 minus year 1. For year 3, it is year 3. For year 3, it is year 3 minus year 2. For year 4, it is year 4 minus year 3. Like this, the capital reinvestment required is also being calculated. Now friends, 3 more numbers are mentioned here: the book equity, the return on equity, and the net income. Let's go to the website Yahoo Finance and find out what the values are. Let's start with the net income. So friends, here I am in Yahoo Finance, and you can see here for 2024, the net income for Bank of America is mentioned here. It is 27,132,000,000. That is 27.132 billion, right? So let me use this number here. 27.132 billion means 27,132 million, right? Now I can easily get to the balance sheet and find out the book equity. Let me go there. So here you can see the balance sheet is also mentioned. Let me click on the balance sheet here, and it is mentioned here the book equity, tangible book value is mentioned here as 203.379 billion. So let me use this number, 203,379. This is the book equity. Now if I have these two numbers, I can calculate what is the return on equity, right? So the return on equity is 27132 divided by 203,379. This is equal to 13.3%. Let me convert it into percentage. This is 13.3%. Let me increase the decimal numbers here. 13.34%. So this is the return on equity for Bank of America. Now this reinvested capital increases the book equity. So let me add the reinvested capital into the book equity to project the future book equities. Okay. So the year 1 book equity is equal to year 1 reinvested capital plus the base year book equity. We have this number here, right? Now we can just stretch it and get the 10-year numbers. And we also assume that the return on equity is kept constant. So this is year 1 is also equal to 13.34%, and for the next 10 years it is kept at that. I'm going to assume that the return on equity will be kept constant. Okay. Now based on this, ignore these numbers. Based on these two numbers in the future projected, that is the book equity and the return on equity, I can calculate the projected net income also. So net income for year 1 is equal to book equity for year 1 multiplied by the return on equity percentage, right? We have the year 1 number and we can stretch it to get the 10-year numbers. Now the next row is very important. Let me delete the values here. Now the next row is the free cash flow to equity banking wise for a banking company, right? So this is equal to net income minus the reinvestment required for every year. Now let me stretch this number to get all the 10-year numbers projected, right? So we have these numbers here. Now we have the 10-year projected numbers, but we want to have a terminal value also, so we can get the perpetual value of Bank of America. Now how do we calculate that? That can be calculated in a different way, friends. Let me go back to the blackboard and tell you how do we calculate that. The terminal value for Bank of America in year 10 is given by the net income in year 11 multiplied by 1 minus the ratio of the perpetual growth rate divided by the return on equity of Bank of America. This whole expression divided by return on equity minus the perpetual growth rate. So I think we know all the values, friends. This can be reduced to values. This can be reduced by numbers. Let me go back to the Excel sheet. Now we know the numbers till year 10. We just need to project it till year 11 to get our required number. So risk-weighted assets for year 10 is equal to 1892,980.421. This is maintaining the same growth rate, right? And therefore the capital, tier 1 capital is equal to, let me stretch the number here. The capital adequacy ratio is maintained at 14.8%. We get the tier 1 capital amount also. And in effect, we actually get the reinvestment required also. This is equal to capital required at year 11 minus capital required at year 10. So we have the number for reinvestment required also, right? The book equity, we can simply stretch it. The 10th year book equity plus the reinvestment required gives the book equity for year 11. And let me say the return on equity is constant at 13.34%. Therefore, we get the net income for year 11 also. This is equal to book equity at year 11 multiplied by return on equity at year 11. This is equal to 35088.487. This is the number for net income at year 11. So we can use this number. So here, let me check the number once again. 35088.4871. 35088.4871. Okay, this is the projected net income for year 11 multiplied by 1 minus the growth rate, which is 2%, 2.2%, so 0.022, divided by the return on equity, which is 13.34% or 0.1334. This entire value divided by 0.1334 minus 0.022. So we can easily calculate this, friends. This is equal to, let me do the calculations. You can also pause the video and do your own calculations if you are doing it. The value comes to be 263,032.137. 263,032. Approximately 263,032. This is the terminal value. So we can write here the terminal value is equal to 263,032. And this is in millions, okay? This is in millions. Let me make it bold here. Now, the next step is calculation of the present value. So let me delete the rows. The calculations are mentioned here. How do we calculate it? Let me show you. Basically, year 1's present value is equal to year 1 free cash flow divided by 1 plus the cost of equity. 1 plus the cost of equity, which is 9.26%, we have mentioned in the previous calculations, raised to the power the number of years, right? This is what it is. And this can be stretched till year 9. And in year 10, we do something else. Let me show you. This is what we get here, right? For the first 9 years, this is the value. And for the 10th year, what we do is we add the terminal value with the net income. So terminal value plus the free cash flow. This entire thing we reduce or discount to the present value. So this is equal to the terminal value plus the net income in year 10 divided by 1 plus the cost of equity raised to the power the number of years. 1 plus the cost of equity raised to the power the number of years, which is 10, right? So we have the free cash flow valuation at 268,005 million. 268,005 million. That is $268 billion is the valuation for Bank of America. This is the entire valuation. We need to find out the per share valuation also. So let me find out what is the number of shares outstanding for Bank of America. So how do we find the per share value? We need to know the number of shares, right? And to know the number of shares, what we need to do is we can divide the market cap with the per share price, and then we get the per share count. That is the number of shares that are there. Now, how do we find the per share value? The per share value is basically the total intrinsic value divided by the number of shares, right? And the number of shares, how do we find that out? The number of shares is equal to the market cap divided by the per share price. So number of shares, this is equal to the market cap divided by per share price. Let me check the numbers out. Per share price for Bank of America is 43.2, right? And the market cap is 325.38 billion. The market cap is 325.38 billion. So 325.38 billion. So 380,123,123. This is the dollar amount for the market cap of Bank of America divided by per share price. This is equal to 43.2. So this is going to give us the number of shares, right? The number of shares we have received here. Now what we'll do is we will divide the intrinsic value with the number of shares and get our per share valuation. So this is equal to 268,005 million. So we multiply it with 1 with 6 zeros. And then we divide the entire amount by the number of shares. Now our intrinsic value according to the free cash flow valuation is $35.58. $35.58. So as per the free cash flow valuation, Bank of America is around 20-25% overvalued currently, right? As we speak, it is 20-25% overvalued. So now we have done the second method also. Now only one more method is pending, which is the residual income valuation for Bank of America. Let's get on with it right away. So the third model is the residual income valuation model for Bank of America. And how do we use it for measuring the valuation, friends? Let's understand. Let's first understand what is the residual income valuation. What is the meaning of residual income valuation? So let's say the book equity of a company at time 0 is B0, right? Now the net income for this company is book equity multiplied by the return on equity, right? Book equity multiplied by the return on equity. This is the net income. And what is the excess income, friends? Excess income is nothing but book equity multiplied by return on equity, which is in excess of the cost of equity. That is return on equity minus cost of equity. This is the excess income, or we call it the residual income. After fulfilling the required return rate, that is the cost of equity rate, what is the excess that it is earning? For example, in case of Bank of America, the return on equity is 13.34%, right? And the cost of equity is 9.26%. So we have some extra residual income coming here, which is fantastic. And based on this, we can do the valuation for residual income. The residual income value of a company with constant growth rate is given like this. Residual income valuation or residual income value of a company is equal to initial book equity at time 0 or the base year plus the present value of all the future residual income. And this is given by, this is equal to present book value of equity plus book value of equity at time 0 multiplied by the excess return that is being achieved, return on equity minus cost of equity, divided by cost of equity minus the perpetual growth rate. Now this is the final expression for residual income valuation. And I know here we are using a lot of mathematical expressions. The derivations for them are precisely mathematical and logical. The links to those derivations are also given below. You can, if you want, you can go and check them out. Now here we know all these values, right? We know the book equity at time 0. We know the return on equity. We know the cost of equity, and we know the growth rate. And we can just put in the values and get our intrinsic value in terms of residual income valuation. We have done that in Excel sheet. So let me show you. So here, friends, we have done this. The book equity at time 0 or the base year is 203379 million, right? Here we can see the value 203379 million, right? Then the return on equity is 13.34, right? The growth rate is 2.20. Here return on equity 1 is mentioned here because we are trying to understand what is going to be the return on equity in year 1. Here the return on equity we have assumed to be constant, so ROE 1 is equal to ROE 0, right? So here it is constant at 13.34%. Growth rate again constant at 2.26%. Cost of equity again 9.26%. We have calculated that. Residual income valuation for Bank of America is 320,912.47 million. 320,912.47 million. And per share value is coming to $42.6068, right? Now the question is, which of these valuations are to be weighed higher and which of these valuations are to be weighed lower? So in my calculation, friends, I think in the dividend discount model, we have used a lot of assumptions. So it is better we weigh it a little less and we weigh the residual income and the free cash flow valuation a little bit more. So according to that, let me highlight the per share value first. Here it is also green. So what I'll do is, I'll give the residual income valuation 40% weightage. 40%. Okay. The free cash flow valuation another 40% weightage. So total becomes 80%, and I'll give the rest 20% to the dividend discount model valuation. Now here we have a proper way of doing things. So let me now use the weightages and find out what is coming to be my conclusion of intrinsic value per share for Bank of America. Now this is coming to be, this is equal to residual income multiplied by 40%, which is the weightage, plus free cash flow valuation multiplied by again 40%, plus dividend discount valuation multiplied by 20%. The final valuation for Bank of America is coming to be $40.94 per share, or $40.95 per share approximately. So this is our final calculation, guys. Let me know in the comments whether you agree with this valuation or not. I will see you in the next video. And thank you so much for staying with me in this video. We'll see you in the next video and next valuation and next stock market related insight. And thank you so much for staying with me in this video. We'll meet in the next video where I share more insights on the markets.
What do you think the valuation of Bank of America is? Share in the comments. If you enjoyed this video, please like the video and subscribe to the channel. Share your feedback in the comment section and share this video with a friend who may find this helpful. Thank you so much. See you in the next video.